Small and medium enterprises, SMEs, face unique challenges in accessing finance, primarily due to their smaller size, limited resources, and often higher risk profiles compared to larger businesses. Nevertheless, financing is crucial for the growth and sustainability of SMEs, whether they need capital for expansion, purchasing inventory, or investing in technology. Common sources of finance for SMEs include bank loans, government grants, angel investors, and venture capital. Bank loans provide a straightforward option for established SMEs with a track record of profitability, though they may require collateral and have stricter approval processes. Government grants and subsidies can provide financial support, particularly for innovation, research and development, or environmental initiatives, but they are often competitive and come with stringent eligibility requirements. Angel investors are individuals who provide capital in exchange for equity or convertible debt, offering more flexible terms than traditional banks. Venture capital is another form of equity financing, typically provided to high-growth SMEs with strong potential for returns, though it comes with a significant loss of control for business owners. SMEs must carefully consider their financing options based on their growth potential, cash flow, and risk tolerance. In addition to traditional financing options, SMEs can explore alternative financing methods, such as crowdfunding, peer-to-peer, P2P, lending, and invoice financing. Crowdfunding platforms, such as Kickstarter or Indiegogo, allow businesses to raise funds from a large number of small investors in exchange for rewards or equity. This option provides access to capital without the need for traditional intermediaries and can be particularly effective for startups with innovative products. P2P lending platforms connect SMEs directly with individual lenders, bypassing traditional banks and often offering more competitive interest rates and flexible terms. Invoice financing allows businesses to borrow against their receivables, improving liquidity without taking on additional debt. Alternative financing methods can provide greater flexibility for SMEs, especially those with limited access to bank credit or established relationships with investors. However, these options often come with higher costs or more complex terms, so SMEs must carefully evaluate the impact on their financial position. Regardless of the financing route chosen, SMEs should also focus on improving their creditworthiness, financial transparency, and business plan to increase their chances of securing funding on favorable terms. In addition to securing funding, SMEs must carefully manage their finances to ensure long-term success. This involves effective cash flow management, budgeting, and financial forecasting to align revenue with expenditures and avoid liquidity shortages. Many SMEs face the challenge of fluctuating cash flows due to seasonal sales or delayed payments, which can create financial strain. Therefore, SMEs need to have systems in place to track accounts receivable and payable, ensure timely payments, and maintain a strong working capital position. Additionally, SMEs must be mindful of their capital structure, ensuring they maintain an appropriate balance between debt and equity financing to avoid over-leveraging. This includes assessing the cost of debt, interest payments, and the potential for dilution from equity financing. Many SMEs also focus on strengthening relationships with suppliers, customers, and financial institutions to facilitate smoother financing and operations. By carefully managing their financial resources, SMEs can position themselves for sustainable growth, secure future funding, and reduce financial risk. Moreover, clear financial reporting and transparent accounting practices can improve credibility with investors, lenders, and potential partners, making it easier to access the necessary resources for expansion.